Let's get back out to Yael for your reaction. Hopefully you got the headlines there. I don't know if you've got the decision in front of you, but they've gone ahead. They've raised rates.
Yes, they've done it again. So surprised the markets for the second month. So I think, I think in many ways it is probably the correct decision because this setback is likely to be relatively short term. We will see weaker December output. We'll probably see a contraction in output in December. We'll see a contraction in output in Q1, but we are expecting a fairly strong bounce back during the rest of the year, which means that in terms of inflationary pressures, you're likely to keep having those, especially because part of this setback in the pandemic means that we are likely to have more pressure on supply chain, more pressure in the port potentially, and that would increase inflationary pressures in the short term as well. So in that sense, they have probably made the right call.
In terms of the inflation path, the central bank now expecting inflation to peak next April 2022 at around 6%. How does that ring out in your view, and what do we need to see in terms of further rate hikes, if any, to see inflation contained to 6%?
So our focus is for inflation to peak just above 6%, around 6.3% in April when you get the next energy cap introduced, and from then onwards for inflation to gradually go down. But when I speak to our clients across the country, they're quite skeptical about that. They feel there's still quite a lot in the pipeline for inflation and for prices to continue going up. So I think there is a risk there that we will see inflation above what the current consensus is, if you like. If anything, there's more of an upside risk because of this new setbacks than otherwise. Because I think also in terms of demand, a lot of the setback in demands that we're seeing at the moment is probably a little bit related to Christmas, where people are a bit more cautious about going out and consuming. We've seen a big drop in bookings for restaurants, etc. And it's just people want to make sure they can have Christmas. And I think come January, we will see activity starting to rise again, because ultimately that variant is not as severe as others. So in that sense, inflation could stay a little bit higher for longer. What we're waiting for is the ease of pressure on supply chain, and that could take a year or even 2 years before we see the end of that. And we're also waiting for weaker energy prices. We were hoping for that to start happening in more significantly in the UK by spring next year. We've seen a little bit of a reduction so far, but it's not really going to come into the equation, if you like, into the numbers in significant way for at least 6 months. So there's still more that we need to wait for. And then ultimately, the big question here is the labor market and whether wages are going to moderate, as we've already seen a little bit of an improvement there with the COVID effect coming out of the equation, if you like, but very tight labor market for sustained longer period is really the key worry for the Bank of England.